setters, welcome to today's Grade 12 Accounting Show. Today we have a special revision lesson on companies' financial statements. We have selected highlights from lessons shown earlier in the term to help you revise this term's work. So please post your comments and your questions on our Facebook page or on Twitter @LearnExtra so we can help you with your revision. You can also download the show notes for today's lesson from learn.mindset.co.za or click on the link on our Facebook page. Now it's time to get on with today's lesson.
We are required to use the information to prepare the following ledger accounts. And what are they asking for? They're asking for ordinary share capital. They're asking for retained income. They're asking for the SARS income tax account. We are required to do the shareholders for dividends. We are expected to do income tax and ordinary share dividends. What does this tell you? That in this particular question, you are asked to do all the accounts affecting a company. So based on the information that we are given, we have to complete these ledger accounts. Just before we continue, let's classify these accounts based on what we did earlier so that you can see, yes, also the appropriation account is asked for. So therefore, my ordinary share capital is an equity account, right? My retained income is an equity account. I'm laying the foundation for you to remember these accounts so that when we get into the accounts, you know exactly how to deal with them. Then shareholders for dividends, SARS income tax. We're not going to comment on that one. Why not? Because it depends on the balance. Right, shareholders for dividends, we know. Balance sheet account, also we know it's a liability. Income tax is my expense account. Ordinary share dividends is my expense account. And finally, my appropriation account, which is my final account. So what have I done? Already, I've set the tone, so you know exactly in which category these accounts would fall. Right. Here's my information. The following balances appeared in the ledger on the 1st November 2012. Ordinary share capital, an amount of 3,200,000. Therefore, in my ordinary share capital, my figure is, so what I'm going to do here now is I'm going to try, because of my limited space in terms of the space given to me, I'm just going to use my folio column as well, but that's fine. You know, obviously, that has to go into the money column. So that's my balance in my ordinary share capital account, remembering that it's an equity account. Equity accounts have credit balances. On the credit side, my balance when? In November the 1st, so that's my date. The 1st, that's my opening balance in my ordinary share capital account. And then I need the balance of my retained income, and that balance was 640,000. Therefore, 640,000 equity accounts have credit balances, and therefore, these are my two balances. So what am I doing? I'm taking the information, putting it into my given accounts, and in that way, I start my question. So we've done our opening balances in terms of the ordinary share capital. We've slotted it in, and we've slotted in the retained income. Now notice something. What did I say? What type of an account is SARS income tax? The answer is, it depends. But now you are told it has a credit balance, indicating to you that this account is now a liability. We are owing SARS money, and therefore, when we indicate our balance, okay, there's my SARS income tax. Because it's a liability at the beginning of the year, there's my date, my opening balance, right? And the balance was 11,000. So therefore, the balance in my SARS income tax account is 11,000 rand. Notice that the question indicated that it was a credit balance. So in other words, whenever you are given SARS income tax, important, it will indicate to you whether it's a debit or a credit balance. Got that? Brilliant. Let's move on. The next bit of information that we have is shareholders for dividends. Now, we know that. This one doesn't have to specify. Shareholders for dividends can only be a liability. Why? Because that's the amount of money that the company owes its shareholders. Notice, shareholders for what? For dividends. So in other words, that's what we owe our shareholders, obviously a liability of 140,000 rand. Therefore, in my shareholders for dividends account, I've got November the 1st, my balance is 140,000 rand. Remember that what did we say? We said that that is a liability because that's the amount that we owe to our shareholders. Right. So we've indicated the opening balance, we've slotted them in where they belong, and now we go on to transactions. What happened in November? On the 1st of November, the company issued a further 900,000 ordinary shares at 3 rand each. Okay? Now, very important. Avi mentioned earlier, while we were chatting during the break, that some of you responded to the challenge question and you mentioned something about par value. Please listen attentively. There are no longer shares of par value. That is not in the curriculum. It's outdated information. What do we have? We have shares that are sold at an issue price. In other words, look at my question. The company issued a further 900,000 shares at 3 rand each. So what is the 3 rand? The 3 rand is what I call my issue price. It's not a par value. Please forget this concept of par value. It's outdated stuff. It's the old curriculum. It's not part of your curriculum. Please keep that in mind. Okay, so there's the proceeds of the issue were banked. So immediately you're telling you we're receiving money. Bank equals money, moolah. We received money. What's happening to my bank account? My bank account is increasing in value, therefore debited. What am I going to do? I'm going to credit my ordinary share capital account. And let me do that. There's my bank entry. There's my bank entry. So you can see I'm crediting my ordinary share capital. It's an equity account increasing in value. It was 900,000 shares at 3 rand each. I'm sure that's an easy calculation for you to do. 900,000 times 3 would give you a value of 2,700,000, and you enter that 2,700,000 on the credit side of your ordinary share capital account. Once again, let's look at the two accounts involved. A debit to bank, we're receiving money, asset increasing in value, therefore debited, and a credit to my ordinary share capital, Y, equity account increasing in value, therefore credited. Right, done and dusted. Next transaction. So we sorted this one out. Now they tell you that SARS and shareholders were paid the amounts due to them. Okay? So let's go back to my accounts and see. Clearly you can see that you were owing SARS money. How much were you owing SARS? You were owing SARS an amount of 11,000 rand. So if we issue a check to pay SARS, the moment you see issued a check, immediately tells you that it's the bank account involved, correct? What's happening to my bank account? It's decreasing in value, therefore credited. Now, if we were doing the accounting equation, and bank was involved, the first question that you ask yourself is, what is the status? Not your status, but the status of the bank account. Okay, what am I referring to? Is bank an asset or a liability? Am I told that the bank account is in overdraft? Then definitely it is a liability. But in this case here, we know that we're not doing the accounting equation, we're doing the ledger account, but the entry remains the same. What's the entry? A credit to bank, why? In this case here, asset decreasing in value, and a debit to my SARS income tax. Remember, my entry is bank because I'm paying it from my CPJ. The amount is 11,000 Rand, and notice what's happening, that my liability is decreasing because I'm paying the liability. I'm paying the amount due to SARS. Who else am I paying? I'm paying my shareholders. So therefore, there's my account, shareholders for dividends, liability, double entry. Once again, notice, I always talk about the double entry. What's my double entry in this case here? A debit to shareholders for dividends. Why? Liability decreasing in value, therefore debited. Detail. Now, obviously, you notice that I'm not focusing that much on the dates. However, in the exams, please, an appeal to you, make sure that you complete the account in its entirety. Put in the dates, put in the folio references. It's just now that we're explaining this, that we are taking the shortcut. Do not take the shortcut in the exams. Make sure that you complete the account in its entirety with the dates, the folio references, etc. Okay, so in our case here, my double entry is bank. Therefore, notice that I'm debiting my shareholders for dividends. Why? Liability decreasing in value, I'm paying it. I've issued a check, my bank account is credited, I'm debiting shareholders for dividends with the amount that I owe them, 140,000 Rand. Okay, got that. So I've done the next transaction that was required of me, and what was that? I've paid the amounts due to the shareholders, and I've paid the amount due to SARS.
Okay, guys, I hope you're enjoying this revision session. If you are struggling and need help, please post on the page or send your questions to the Learn Extra Help Desk. The links are on our Facebook page. But now it's time to take a very quick break. Don't go away. We'll be right back. Welcome back from the break, guys. Doing revision is really important, so I hope you are enjoying this lesson. I'd love to chat to you on our Facebook page or on Twitter, so please let us know how you are doing. Enough of the chat, now it's time to get back to some more revision.
Now, guys, I'm going to do this slightly differently. I want to start off first with analyzing financial information. So in other words, I'm starting off with, you guessed it, ratio analysis. Okay, so in this particular question, we are given two companies. Abram, I'm going to ask your assistance if I pronounce the names incorrectly, okay?
Yeah,
Okay, right. We're given Mkabela Limited, and guys, please forgive me, but I'm going to try and refer to Mkabela Limited as MK, if that's fine. And then we've got our next company, which is Yembe Limited. Did I say that right?
Yes.
Yembe Limited. Right. So in terms of the information that we've got in front of us, we already have financial indicators. So we've got the market price on the JSE given to us, the net asset value given to us, then we've got earnings per share, dividends per share. So we've obviously got a whole list of ratios already calculated for us. Right, that is the information that we have. There is a bit of additional information as well, so let's go through that. Note 189,000 ordinary shares for both companies were issued at the end of the accounting period or at the end of the financial year. MK Limited issued same shares at 450 cents or 4.50, guys, while Yembe Limited issued the same shares at 12 Rand or 1,200 cents. Okay, let's now go to our questions, or what we need to do in terms of this particular information that we have in front of us. So hopefully I can, yeah, there's my answer book. Let's just quickly go to this part of the question. Okay, it should be, there we go. Right, guys, so in terms of the questions, let's look at the very first question. Comment on the price at which the new shares were issued for both companies. Okay, so that was the additional information that I just read out. Both companies issued new shares at the end of the financial year. We are required to comment on the issue price of these shares. Will the directors and the shareholders be satisfied with this? Explain by quoting relevant figures from the question in each company. Okay, right, so guys, let's start with the very first company. Okay, we're starting with MK Limited. Now, we need to firstly look at what was the issue price. Okay, so the additional shares were issued at, let's go to our information. Right, there we go. So for MK Limited, they issued the shares at 4.50. So I want to take this bit of information to my answer sheet. Okay, so let's go to our answer sheet. The issue price was 4.50, or you can leave your answer in cents, it's still absolutely fine. Now, what are we going to compare this issue price to? Now, remember, guys, the issue price is determined by looking at your net asset value. So we need to look at net asset value as well as the market price. What are these shares selling for on the JSE? That's our market price. So we're going to look at the net asset value as well as the market price of our shares. So again, let's go back to our information. Right, there we go. The market price per share on the JSE for MK Limited is 7.10 Rand, while the net asset value per share for the same company is 5.35 Rand. So let's take that information again to our answer sheet. JSE 7.10 Rand. Okay, and the net asset value 5.35 Rand. Right, now guys, let's look at this very, very closely. The issue price is obviously 4.50. The shares are worth, the net asset value, your shares are worth 5.35. So you should get at least 5.35 if you sell the shares, because that's the worth of the shares. The JSE tells you about the general public out there. They are willing to pay 7.10 for the shares. So although the shares are worth 5.35, the JSE, the public out there, is prepared to pay 7.10 for shares in MK Limited. Right, so immediately, guys, this is the share price of 4.50. Okay, the company, the directors, they could have sold the shares at a much higher price. So will the shareholders, the existing shareholders, be satisfied with this? The answer is definitely not. Okay, no, they're not going to be satisfied. The reason? The net asset value as well as the market value is much higher than the issue price, or you can obviously state the opposite as well. The issue price, let's write this down, the issue price is much lower than the JSE, or you can state market price and net asset value. The fact that they've sold it for a much lower price, guys, what will this, or how will this impact on your shares? Your JSE price will, because of this, it will probably drop. And remember, you don't want that. As a company, you don't want that to happen. Okay, right, let's move on to the next company. Let's look at their issue price. And again, we're comparing the issue price to the JSE as well as to the net asset value. So we're going to start off with what was the issue price for the shares that were issued at the end of the financial year. Okay, so if we scroll down, there we go. Nyembe Limited issued their shares at 12 Rand or 1,200 cents. So let's put that in. Okay, so my issue price is 12 Rand. And again, I am now looking at what was the net asset value of my shares as well as the market value on the JSE. Okay, so for this particular company, there we go. The market price is 9 Rand 20 cents and the net asset value is 11 Rand 20 cents. Okay, so let's put that in as well. The net asset value is 11.20 and the market price 9 Rand 20. Right, so in this case, guys, there's obviously a very different scenario. So the net asset value, my shares are worth 11 Rand 20. The market, however, is prepared to pay 9 Rand 20, but when I issued additional shares, I managed to sell the shares at 12 Rand. Now remember, as a shareholder, you're going to be satisfied with this because the issue price was much higher than the net asset value, the worth of the shares, as well as the JSE price. So yes, the directors will be satisfied with this, as well as your existing shareholders, as issue price is much higher. Okay, so it's much higher than your net asset value as well as your JSE. And remember, guys, the question wants you to quote financial indicators, and I've done that. Okay, right, let's now move on to the next question on this information. Okay, our second question, consider the use of loans by the two companies. Which company is making more use of loans? Quote a financial indicator for each company to indicate this. So they're asking us to look at certain ratios, financial indicator, and then obviously answer which company is using or relying more on borrowed capital using more loans. We're also required to explain whether or not it was a good idea for that company to make use of loans, and again, quote one financial indicator to indicate this. Okay, right, so let's look at which ratios are going to firstly help us to answer the first part of this question. Okay, guys, we're obviously looking at risk. And when we talk about risk, we are comparing our own capital to borrowing capital. So immediately the ratio that comes into mind is your debt equity ratio. So if we go to our information, okay, so we're looking at debt equity ratio. There we go. There's our debt equity ratio. We've got MK Limited. Their debt equity ratio is 0.2:1, while Nyembe Limited's debt equity ratio is 3.1:1. So now remember, guys, debt, okay, we've got debt equity. Right, let's take this bit of information, put it into our answer sheet so it makes much more sense and the mindsetters can actually see this. Okay, so we've got MK Limited, their debt equity ratio is 0, let's go back to our information. It is 0.2:1. Right, and then we've got Nyembe Limited. Their debt equity ratio was much higher. Okay, it was 3.1:1. Okay, guys, now absolutely simple and absolutely straightforward, and I know you guys are probably shouting out the answer. Who's relying more on borrowed capital? Remember, this refers to our equity, okay, and this refers to our debt. Similarly, there's our debt and there's our equity. Okay, absolutely correct. Nyembe Limited is relying more on loans because for every 1 rand of own capital of equity, they rely on 3 rand 10 cents of borrowed capital. So the answer for the first part of the question would be Nyembe Limited. Right, the second part to this question. Explain whether or not it was a good idea for that company to make use of the loans. Quote one financial indicator to indicate this. Okay, Abram, you're really quiet, so I'm going to come to you.
Okay.
Why do you think a company or a business will borrow capital?
Because they're in shortage. They need to pay other stuff.
Ok-
Or sometimes when the business is starting, they need to buy equipment and other stuff.
Okay, in other words, exactly what you explained, you borrow capital in the hope that you're going to use the borrowed capital to expand your operations
Yes.
and generate more profit.
More profit.
Okay,
yes.
so you're obviously focusing on returns. When we talk about returns, guys, we're talking about obviously profit. You're borrowing capital in the hope that you're going to use the bank's money to generate more capital. So immediately, the ratio that I'm focusing on is return on total capital employed. Right, now when it comes to Nyembe Limited, remember, when you borrow capital, you've got to pay back, Abram. If I borrow capital, is it for
Yes.
free? I've got to pay
No.
back the capital and,
And
the
the
interest.
interest, yes.
Okay, so I've got to pay back interest. So let's examine our return on total capital employed for this particular business. So if I go to my information, there we go. Right, my return on total capital employed for this particular company is 16.8%. Okay, so let's just write that down. My return on capital is 16.8%. I'm going to now compare this to the interest that I'm paying. So again, back to my information. Return is 16.8%, whereas my interest, guys, is 17%. So I'm getting out my return, 16.8%, but the interest that I'm paying back is 17%. So is it even worth me borrowing this capital? It's
No,
not. I can see
no,
Abram
no.
shaking his head. It's not. Okay, so this company is using so much of borrowed capital, but look at their return compared to their interest. Okay, right, so
Talking about interest, Mahesh, I
Yeah.
just want to know what happens in a case where you borrowed the cash,
Yeah.
the capital from a friend, and they don't charge you the interest.
they don't. The
Yeah.
friend doesn't.
Yeah.
Oh, you need to
Or
tell me who that
family, or
friend is or
family.
who that family is, because then we all are going to borrow money from them.
But they're trying to help you,
Yeah,
like your dad
yeah,
might try to
yeah.
help you if you're starting your business
Yeah.
or if your business, also in the hope that you'll make more returns and pay
Yeah.
them back their money.
Okay, so in that case, then your interest expense is 0, which
Okay.
means you're showing a higher profit in your financial statements.
Okay. which is
Okay,
good.
which will be excellent. Right, so guys, in this particular answer, I'm comparing it to my 17%, which is the interest rate. And again, going back to the question, okay, explain whether it was a good idea or not. Definitely not a good idea. Okay, so no. And your reason, your interest paid is much higher. So your interest paid is much higher than your return on total capital employed. Okay, right. So in terms of this question, remember guys, we're now moving on to a different company. In this question, we're required to complete the note for the reconciliation of net profit before tax and cash generated from operations for the year ended 28th of Feb 2014. Okay. Right, let's now go to our information. Okay, there we go. There's our information in terms of Alwanda Limited. So we've got a bit of information from our income statement as well as our balance sheet from what I can see. And then if we scroll down, there's a bit of additional information which we're going to get to. Okay, right, let's now start with the very first question, completing the note or note number 1 to our cash flow statement. Right, guys, as you've already noticed, I filled in certain figures because this is going to help us to focus on calculations that for some reason we tend to get incorrect in the exam. So if you refer to this particular question, remember the figures filled in normally or generally are not filled in, but I filled it in so that we can get to those important calculations. Right, this particular note you guys are absolutely familiar with. We're going to start off with net profit before tax. Okay, so let's now go to our information. So in my information, I'm looking for net profit before tax, okay, but for some reason, I have net profit after tax. So they're not giving me net profit before tax. Okay, next step, I should look for taxation. Okay, income tax, I'm scrolling down, there's no income tax, so I need to now go to my additional information, and there I find something. Income tax is calculated at 30% of the profit. Okay, so they're not giving me the income tax, but they're telling me it's calculated at 30% of net profit. Now, in terms of what I'm trying to work out, I'm obviously looking for net profit before tax. Okay, so net profit before tax, guys, is always at 100%. 30% of that is in terms of my income tax, which means net profit after tax as a percentage, in this case, would be 70%. I'm now going to use these percentages to calculate my net profit before tax. Okay, so I've got net profit after tax. I'm going to take this amount and I'm going to multiply it by, I want to calculate net profit before tax. I want to calculate what was the 100%, divide that by what I have, net profit after tax is 70%, guys. So I'm going to divide that by 70, and that will now give me my net profit before tax. And remember, should have mentioned this earlier on, we're looking at the 2014 financial year. So let's get our calculator out and let's do this calculation. So 522,900 times, I want net profit before tax, I want 100, divided by 70, and my net profit before tax an amount of 747,000. So let's take that through to our answer sheet. Net profit before tax, 747,000. Okay, remember guys, show your calculations in brackets. Right, I've got that figure, let's move on. We're now going to make an adjustment for depreciation. So remember, I add back my depreciation as well as interest expense will be added to your net profit before tax. Where am I getting this information from? I know you guys know this already. I'm getting it from this table. So there's my depreciation, there's my interest expense, and again, it's for the 2014 financial year. Right, so let's carry on. Okay. Okay, back to my calculator. Net profit before tax, I am adding back my 56,000 as well as 19,500, and that gives me net profit 822, just get that out again, 500. Okay. Right, let's now look at the second part to this note, changes to working capital. And again, guys, I've filled in figures already. Let's quickly go through the calculation. Okay, my changes to working capital, I'm looking at inventory, I'm looking at debtors as well as creditors. So I'm looking at, has my inventory increased from the previous year to this year? Has my debtors increased or decreased? And obviously the same with creditors. And again, I'm getting this information from the table. So let's start with inventory. 2014, my inventory, an amount of 220,000. 2013, my inventory 185,000. So if I compare the previous year, which is 2013 to 2014, there's obviously been an increase. Okay, remember guys, you need to write this down. Increase in inventory. So I'm subtracting to get the increase. the increase being 35,000. In other words, the business spent more on stock this year, and therefore it's considered to be an outflow of cash, hence it is in brackets. Right, let's move on to debtors. Okay, in terms of my debtors, guys, again, I filled in the figures already, so it makes it much more easier for us. I've got 2014, and I've got 2013. So if I again compare my debtors at the end of 2013 were owing the business 113,000. 2014, my debtors are now owing 141,000. So again, there's been an increase in debtors. An increase in debtors, your debtors are taking much longer to pay their account, and hence it's an outflow of cash because the business is actually financing your debtors. Right, move on to creditors, the last component of our working capital. So in terms of our creditors, again, guys, 2014 is being compared to 2013. So start with 2013. We were owing our creditors 85,500. 2014, we're now owing our creditors 145,000. Now remember, guys, the longer you take to pay your creditors, the better it is for liquidity. Okay, some of you might be thinking, and I'm sure Abram is probably thinking, the longer I take to pay someone, okay, why is that better for liquidity? Because the money is sitting in my bank account. Okay, so the longer I take to pay my creditors, the better it is for liquidity. Okay, and the better it is for working capital. So therefore, this difference is considered to be an inflow of cash. That money is staying in your bank account. Okay. Right, so at this stage, I've completed the note. Cash generated from operations would simply be my net profit before changes to working capital minus my changes to working capital, 3,500, which is obviously the sum of these three figures. So let's quickly do that. Okay, so minus 3,500, and that gives us 819,000. Okay.
Okay, guys, I hope you're enjoying this revision session. If you are struggling and need help, please post on the page or send your questions to the Learn Extra Help Desk. The links are on our Facebook page. But now it's time to take a very quick break. Don't go away. We'll be right back. Welcome back from the break, guys. Doing revision is really important, so I hope you are enjoying this lesson. I'd love to chat to you on our Facebook page or on Twitter, so please let us know how you are doing. Enough of the chat, now it's time to get back to some more revision.
Right, guys, let's now move on to today's question that we're going to focus on, which is our balance sheet. And in this particular question, we are going to be completing the following notes: the ordinary share capital note, retained income, and then an additional balance sheet note, your trade and other payables. We're obviously also going to be looking at the balance sheet as at 28th of Feb 2014, but remember, guys, today's focus is understanding your adjustments. Okay, so let's look at our information. Right, so the information that we have, the information below was taken from the accounting records of Vaish Limited. The financial year ends on the 28th of Feb 2014. We are given an extract from the general ledger for the year ended 28th of Feb 2014. So if we scroll down, okay, there's our general ledger extract. I'm not going to focus too much on this extract, but remember, guys, this information is what you take to your balance sheet as your opening balance before you obviously attempt your adjustments. Right, let's get started, and let's now look at our very first adjustment. The net profit before tax of 29,271 was calculated after taking into account the adjustments below. Right, guys, net profit before tax. Remember, we're busy with the balance sheet and some balance sheet notes. So it means I need to now transfer my net profit before tax, 29,271, will get transferred to my retained income note. Okay, so let's go and do just that. So in my answer sheet, let's quickly find our retained income note. There we go. So our net profit, remember, we're obviously looking at net profit after tax, but they're giving us net profit before tax. So in brackets, I've already brought down the 29,271. Okay, let's now move on to our next adjustment. Okay. Right, our second adjustment, ordinary share capital, comprises of the following. So we can now complete our ordinary share capital note. Okay, Tara, I don't know, for some reason...
I think, you know what I think
you
we
think I'm
must
moving
do?
too fast? Yeah.
I think, you know, above where you choose your colors, there's
Yeah.
a little cursor. I think you have to select that.
Yeah.
Okay, well,
Cursor.
so where you see the three little pins,
Yeah.
a little bit to your left.
Is it the arrows?
No, a little bit in the next sort of section, so a little bit further.
Okay. Right, left.
Okay, let me...
Can you come and help
So
me?
over here,
Yeah.
I think what we have to do is you have to click that in order
Okay.
to move, and
Okay.
then click back in order to write, I
Okay,
think.
okay.
But I'm not too sure.
Okay, let's see if it works.
Okay, there we go.
Okay, there we go.
Is it...
It's moving a bit too fast. Okay, let's try one more time. Okay, there we go.
Okay, one step at a time.
One step at a time. Thanks, Tara. Ordinary
Pleasure.
share capital comprises of the following. Balance as at 1st of March. So let's get our pen back
There we
now.
go.
There we go. So my balance as at 1st of March 2013, in other words, my balance at the beginning of the year is an amount of 200,000. Now remember guys, when I'm disclosing this information in my ordinary share capital note, I need the number of shares issued at the beginning of the year as well as the rand value of my shares. So if I read further, the number of shares issued is given to me, 100,000 shares, and the rand value is 200,000. So let's take that bit of information through to our note. Okay, so there we go. That's retained income. Let's just go back and let's follow Tara's instructions. There we go. Works like a charm.
Awesome.
Right, so issued. Let's get our pen out. Okay, so there we go. We've got 100,000 shares issued at the beginning of the year. And remember, my rand value is an amount of 200,000. Okay, very, very straightforward, very simple. Right, let's go back to the next bit of information. On the 1st of September, so this is obviously during the year, 2013, a further 100,000 shares were issued at R2.50 each. Right, so during the year, you obviously now issued more shares or you sold more shares to your shareholders and your issue price was R2.50. So if I need my number of shares as well as the rand value, the total that was received for my shares. Now, because I'm not feeling well, guys, I'm going to use the calculator. So I've got R2.50 times 100,000. Okay, and that gives me additional capital during the year 250,000. So my additional capital that I'm going to now record in my note is 200,000. So again, let's take that information through to our answer book. Nothing difficult yet, everything quite straightforward and simple. So 100,000 additional shares were issued during the year at R2.50. Okay, to give me additional capital that we calculated, 250,000. Right, again, back to my adjustment. On the 1st of February 2014, the company bought back 50,000 shares at R2.50 each. So in other words, I've now come across a buyback of shares where obviously the business has now bought back additional shares from their shareholders. Now remember guys, when you are looking at buyback of shares, let's just quickly, there we go. Right, when we're looking at buyback of shares, so we purchased 50,000, let's get our pen out. We purchased 50,000 shares, and the buyback price was 2 Rand 50. Right, we're now going to look at our shares that were in issue before the buyback in order for us to calculate what was that average price in terms of our shares. So let's quickly construct a T account for ordinary share capital. So my opening balance was 250,000. We then issued a further 100,000 shares at 2 Rand 50 each to get a further 250,000. I think I just made a mistake. Let's just quickly double check. I think my opening balance was 200,000. Okay, yeah, it was 200,000. That's right. There's my opening balance, 200,000. So let's quickly fix that, guys. So our opening balance, an amount of 200,000. Okay, so if I look at my total capital value, it will be 450,000. Now remember, guys, in order for me to calculate my average price, I'm taking the total value of my share capital before the buyback. In this case, it's 450,000, and I'm going to divide my 450,000 by the number of shares in issue. Okay, so the number of shares in issue, so I'm going to take this and I'm going to divide it by, okay, let's get the pen out again. So I'm going to divide this by number of shares in issue, 100,000 plus the additional 100,000. So I'm dividing it by 200,000. Right, so that's now going to give me my average price. So let's get our calculator out. Okay, so we are taking 450,000 divide by number of shares issued, 200,000, and that gives us an average price of 2 Rand 25. Okay, so my average price is equal to 2 Rand 25. In other words, my share capital will decrease by 2 Rand 25. So remember, the buyback was 2 Rand 50. My share capital will now decrease by 2 Rand 25. The balance, 2 Rand 50 minus 2 Rand 25, is going to give me the remaining amount of 25 cents, and that will now reduce my retained income. So let's focus first on share capital, and then we will turn our focus to retained income. Okay, so my share capital will reduce by 2 Rand 25 times the number of shares that were bought back, which was 50,000, to give us 112,500. So let's fill that in, 112,500. Okay. All right, let's record this in our answer book. So bought back during the year, the business bought back 50,000 shares during the year, and our share capital reduces by, just get that figure out again, an amount of 112,500. Okay, not difficult, guys. Requires maybe a bit of calculation, but I promise you it's not difficult. Right, let's now go back to our adjustment. Okay, so we've dealt with ordinary share capital, but remember, guys, as accounting students, we normally are extremely intelligent. Okay,
There we go.
Sorry, science students.
It's fine.
Right, because remember, good accountants are not only good with figures, but they're also extremely good with time. So when I'm dealing with this particular adjustment, and I know that a certain part of the adjustment, in this case, the 25 cents, deals with retained income, I'm going to deal with that adjustment immediately. I'm not going to wait until I get to the question on retained income. That is why it's so important that you read your entire question first before you start answering. Okay, so let's do that. Let's deal with our retained income. Remember, we've reduced our share capital. We now need to also reduce retained income. So again, let's get our calculator out. Okay, so the buyback we bought back 50,000 shares, and our retained income portion will reduce by 12,500. So my 12,500, immediately I'm going to now go to my answer book, and I'm going to go to the retained income note. Okay, there we go. So there's retained income. My buyback during the year. So buyback during the year, retained income will reduce by 12,500. Okay, let's now move on to adjustment 4. The directors declared a final dividend of 12,000 Rand. No interim dividends were paid during the year. Okay, guys, it cannot get easier than this. They're giving you the actual amount. So the dividend has been already calculated for you, an amount of 12,000. Now remember, guys, this 12,000 will be entered in my retained income note, as well as it has been declared, meaning it hasn't been paid as yet. So this is obviously a liability and will be entered also under trade and other payable note. Okay, so let's go to our notes and let's enter this 12,000. Right, we're going to start with retained income first. Okay, so there's my retained income. Ordinary share dividends paid. There hasn't been an interim dividend, but my recommended, which is the final dividend, the amount is 12,000. Remember, we always put this into a little block. And my ordinary share dividend, which is an expense, so in brackets, this amount of 12,000. I also need to enter this under trade and other payable. Shareholders for dividend, we are owing our shareholders an amount of 12,000. Okay.
We've come to the end of today's show. Thanks for joining me and for chatting to me during the show. Please visit our website, learn.mindset.co.za, to get the notes and to watch the videos from earlier in the year. And remember, we are here to get you through the year, so stay connected. Goodbye.